Imagine a financial system where your investments align perfectly with your faith. It sounds ideal, right? But what if that system was riddled with mistrust? That's the challenge Bangladesh is attempting to address with its groundbreaking move to introduce Shariah-based short-term bills. The government is planning to launch Shariah-compliant short-term bills in early 2026, a first for the nation. Bangladesh Bank will manage the issuance of these bills, ensuring the government can raise funds specifically earmarked for social development projects. This initiative aims to create a much-needed investment avenue, particularly at a time when confidence in traditional Islamic banking has been shaken. Think of it as a new, ethically sound option for investors seeking alternatives. On the 11th of this month, the Cash and Debt Management Committee, CDMC, operating under the Finance Division, formally approved this policy. A high-ranking finance ministry official confirmed this development to the Business Standard. These Shariah-based bills will have tenures typically shorter than 1 year, with plans to offer options maturing in 3 months, 6 months, and 1 year. This short-term nature is designed to encourage greater investment activity, as it provides flexibility and reduces perceived risk. The funds raised through these bills will be dedicated to social development projects. When the government needs capital, Bangladesh Bank acts as the central facilitator, releasing bills and bonds into the market. These instruments allow the central bank to gather funds from a broad spectrum of investors, including individuals, banks, insurance companies, and other financial institutions. Economists and bankers view these Shariah-compliant bills as a positive step for the economy. They will provide a dedicated investment pathway for individuals and institutions adhering to Islamic Sharia principles. The short-term nature of these bills is also expected to boost investment activity in this sector. But here's where it gets controversial. Recent events have cast a shadow of doubt over Sharia-based banking in Bangladesh. Specifically, issues surrounding 5 Islamic banks slated for merger, where customers faced difficulties withdrawing their deposits, have eroded trust. This incident led to significant deposit withdrawals, and some depositors are still awaiting their dues. Therefore, these Sharia-based short-term bills are intended to offer a reliable alternative investment opportunity. They represent a fresh start, separated from the complexities and uncertainties surrounding those earlier banking challenges. According to Zahid Hussain, former lead economist at the World Bank Dhaka office, this initiative caters to a significant segment of the population that adheres to Islamic Sharia principles. He emphasizes that the crisis of confidence in Islamic-oriented banks has had a tangible impact on the economy. He further notes that customers deposited funds in those 5 banks based on trust, but irregularities prevented timely withdrawals. The introduction of Islamic bills aims to create a new, trustworthy investment landscape. And this is the part most people miss. Traditional banks have a wide range of investment options available to them, but Sharia-based banks face limitations. Therefore, these bills open up a new avenue for Islamic banks, financial institutions, and insurance companies to deploy their capital. The merged banks will also gain a valuable opportunity to invest in these bills. A former managing director of a Sharia-based bank sees this as a chance to generate profits by tapping into a new investment sector. He explained that Islamic-oriented banks, constrained in their lending activities, often lack alternative investment outlets. While conventional banks can invest in treasury bills and bonds, Islamic banks have been largely excluded. These new bills will provide a welcome solution, enabling them to invest depositors' funds in a Sharia-compliant manner. It's important to note that a large portion of traditional banks' current income is derived from investments in treasury bills and bonds. A senior official at the central bank stated that the introduction of these Sharia-based bills is driven by strong market demand. The expectation is that these bills will be launched before or during the next Ramadan. Individuals, banks, financial institutions, insurance companies, and other entities will be eligible to purchase these bills. The decision to introduce these instruments is a direct response to the demonstrated market need for Sharia-compliant investment options. As a foundation, the government first introduced Islamic bonds, sukuk, in late 2020. Subsequently, Bangladesh Bank issued 2 more sukuk in December 2021 and the first half of 2022. These sukuk provided Sharia-based banks and Islamic banking windows within commercial banks with opportunities to invest in government securities. A senior Bangladesh Bank official clarified that while traditional banks can invest in various instruments like repo, treasury bills, bonds, and other government securities, Islamic-oriented banks have been restricted. These new bills are intended to bridge this gap. In fact, investment in treasury bills and bonds has significantly boosted profits for traditional banks. At the start of 2025, the outlook for Bangladesh's banking sector seemed uncertain, with rising deposit interest rates, persistent inflation, sluggish loan demand, squeezed margins, and political uncertainty fueling fears of declining earnings. However, the opposite occurred. Private banks, especially those considered high-performing, saw their profits not only sustain but actually grow. This growth wasn't driven by loan expansion or new business ventures, but rather by substantial income generated from government bonds and treasury bills. Government securities effectively became a lifeline for banks, reshaping the financial landscape of the entire sector. The transformation is evident in the case of BRAC Bank. Between 2020 and 2022, the bank's investment income ranged from TK 700 crore to TK 800 crore, but in 2024, it soared to a record TK 880 crore, nearly a fourfold increase in just 2 years. Investment income surged by 67% in 2023 and another 127% in 2024, significantly outpacing the bank's income from loan interest and other fees. In the first 9 months of 2025, the bank's net profit jumped 50% year-on-year to TK 1553 crore. However, during the same period, net interest income, the difference between loan and deposit interest, declined by approximately 7%, or TK 100 crore. In essence, income from treasury investments kept the bank's earnings afloat. Similar to BRAC Bank, Citi, Dutch Bangla, Prime, MTB, and Eastern Bank are also generating income through investments in treasury bills and bonds. So, what do you think? Will these Shariah-based bills truly restore trust in Islamic finance and provide a viable investment alternative? Or are there underlying issues that need to be addressed first? Is relying so heavily on government securities for bank profits a sustainable strategy for the long term? Share your thoughts and opinions in the comments below.